I look at the description of your company on the internet, it says non-systematically important, non-deposit taking, non-banking financial institutions. So there is a lot of jargon in here that might be difficult for viewers to interpret. If you can break down these terms.
So the problem today when you think about financial inclusion is two things. One is the cost of customer acquisition. So whenever you think about a customer, you typically have to acquire a customer either by doing digital marketing. Secondly, the cost of processing a loan. So when you think about the cost of processing a loan, right, typically a bank requires potentially anywhere between 500 to 1000 rupees to process a loan application.
Okay.
So that's why, one of the fun exercises that we do over here is for a new employee, we actually ask them to go to their bank of choice and you ask them for a 5,000 rupee loan.
Okay.
Even if you have 50,000 rupees in your bank account, they'll not do that. Internet is going, in fact, where roads don't go today.
Does this company have anything to do with Apollo Group?
It has nothing to do with the Apollo Group.
Let's say I were to default on the loan that I took from you, how will you as a company approach me for the discovery of that loan?
I think
Hi everyone, today we are at Apollo Finvest India Limited in Bombay. It's a 250 CR market cap company. In previous seasons of Green Sharks, we did interview two NBFCs, but what Apollo Finvest is doing, it's entirely different. They are into digital lending. The space is still very niche at a very nascent stage, but is growing. We have with us Mikhil Innani to discuss everything about the company and the industry. Thank you for joining us today.
Pleasure.
Mikhail, we all know you as the co-founder of PharmEasy, and you have also headed the product division at Hotstar. So now Apollo Finvest, all these fields are poles apart. So walk us through your journey as a promoter.
Yeah, I mean, that's a great question. I get this quite often that, I tend to do things which are widely different from each other. But, the interesting insight really is that the common thread across all of this is really technology, right? So like my golden belief is that, I love technology. I'm very passionate about it. And wherever I see that, we can end up using technology to make things a little bit more inclusive, I love to go in that direction, right? So if you think about, something like PharmEasy, the goal was really to make affordable healthcare, make it accessible for as many people as possible. And, technology did that over there. When you think about Hotstar, right, it really democratized entertainment. It was like giving everybody on their mobile phone a TV, basically, right? So that was pretty fun. And now at Apollo, obviously the mission is a little bit larger, where we're trying to drive financial inclusion. And that's why I love technology, right?
So I think technology is the backbone of all the industries that you've worked in.
Absolutely, right? And what I like about technology is that, even though we're all fascinated by Silicon Valley and, how much amazing innovation happens over there, I think in a place like India, technology is like really a big need because the disparity here is the most, right? And that's where the magic of technology brings things to pretty much everybody who, necessarily before that couldn't afford it.
So is it a family business or was this company started by you? And does this company have anything to do with Apollo Group?
A great question. So in a way, yeah, it is a family business. But it has nothing to do with the Apollo Group. That's a common question which we keep on getting. So the history of Apollo is that, it was started by my dad, Ramesh Innani, in the 1980s. Unfortunately, when I was very young, when I was like in third standard or so, my dad passed away. And after that, the company didn't do too much, to be honest, right? It was a listed company. It was pretty much dormant, after that. But really, over the last 8 to 9 years, that's when I think the trajectory of the company completely changed. Because that's when, me and my co-founder, who also happens to be my wife, we entered the company. So it was first her who came in. She's the one who's the banker. She's been in HDFC. She's an MBA in finance, and all the finance whiz inside the company is all her. And I came in with my technology background, and we decided to really figure out what lending 2.0 in the country looks like, right? And that's what Apollo Finvest is all about.
Oh, that's really nice to hear. So if I look at the description of your company on the internet, it says non-systematically important. non-deposit taking, non-banking financial institutions. So there is a lot of jargon in here
Yeah.
that might be difficult for viewers to interpret. If you can break down these terms.
Yeah, that's a great question, right? So I think what this all means in very, very simple words, right, is when you say we are non-systematically important. So typically RBI has a particular threshold,
Okay.
right, which is the regulator of the industry. They typically say that if you are above a certain size, then they regulate you very, very closely, because the idea from their perspective is that they want to make sure that anything which could adversely impact the economy at large, they want to have tighter controls over.
Okay.
Right. So Apollo Finvest today, because we are fairly young as compared to the HDFCs and Bajaj Finservs of the world, right? I think we aren't that, I would say, very, very closely regulated. With us, we have our audits that they do every quarter. But other very large institutions, as an example, will have very, very close audits where potentially RBI could even come into their office and do deeper audits.
Okay.
What non-deposit taking means, right? Like, a classic example is a bank where, HDFC as an example, right? Or ICICI, you and me can go in and deposit our money over there, whether it's in a current account or a savings account. With Apollo, the general public is not able to deposit money with funds with us. If Apollo was to raise any capital, it has to ideally do it in the form of an NCD or maybe raising loans from other NBFCs, which are the other lenders or other banks.
Okay.
And obviously, you can even do equity as well. But taking money directly from the public in the form of a deposit, that's not something we can do.
Okay.
So this is just a little bit of explanation about.
Okay. So when I went to your website, it says you are basically AWS for digital lending, right?
Yeah.
AWS as well as digital lending. These are very difficult terms to understand because even I am not from science background.
Yeah.
So what does this mean?
Okay, so in very simple terms, right? Like, let's go back a bit.
Like, what exactly do you do?
Perfect. So let me start by telling you a little bit of background.
Okay.
Right. Like I said, right, my background is nothing to do with finance, pretty much, right. My general background is to build scalable platforms. Like if you think about Farmeasy or a Hotstar, right, they were all large platforms essentially where we took something and we scaled it using technology. The goal with Apollo Finvest, if I say my goal is financial inclusion, it's a very, very large goal to have. It's not something which I think is easy to accomplish, right? It's more like a mission statement of sorts, right? Now, if I want to do something which is so bold and so huge, how am I going to differentiate as compared to every other player out there, right? How do I compete with an HDFC? How do I compete with a Bajaj Finserv, right? So we really took this to heart, right? And one of the things, our philosophy was that if you have to go after financial inclusion, right, we have to really think about what is the problem today. So the problem today, when you think about financial inclusion, is two things. One is the cost of customer acquisition, right? So whenever you think about a customer, you typically have to acquire a customer either by doing digital marketing, which is doing ads, getting them to come up on your app or a website, or you have to open up branches, right? All of this is of course capex expensive, so it is expensive. Secondly, the cost of processing a loan, right? So when you think about the cost of processing a loan, right, typically a bank requires potentially anywhere between 500 to 1,000 rupees to process a loan application. Okay. So that's why, one of the fun exercises that we do over here is for a new employee, we actually ask them to go to their bank of choice, right? Like say as an example, you go to HDFC and you ask them for a 5,000 rupee loan. Okay. Even if you have 50,000 rupees in your bank account, they'll not do that, right? They'll not be able to give you a 5,000 rupee loan, even though it's pretty much, risk-free for them, because the cost doesn't make sense for them to go ahead and do that kind of loan. So what our philosophy really is, how do you solve this problem? Because when you think about financial inclusion, most of India actually requires really small ticket size loans, right? Because for the large ticket size loans, banks are there.
There are ample entities available to give them loans.
Exactly, right? So the solution is you have to develop something where the cost of customer acquisition becomes zero and the cost of processing a loan application trends towards zero. How do you do all of this? So this is where we've innovated, right? So number one, when it comes to cost of customer acquisition, our philosophy is that every app on your phone today is a branch of Apollo Finvest,
Okay.
right? So any app, whether it's an Ola, Uber, Flipkart, Amazon, Zomato, whoever it is, right? They could partner with Apollo and originate loans on our behalf.
Okay.
Right.
But right now you're working in the edtech space, right? Only, sorry, fintech.
Yes.
Okay.
Yes. So what fintech really means is that when we are accepting loans from them as leads, right? We're doing all of this 100% digitally.
Oh, okay.
Now this leads to the second part of my thesis, which is the cost of processing a loan has to trend towards zero. How do you do that? And why is now the right time to do this, right? Because of two reasons. Reason number one is that today we have Geo. So what that has resulted in is that roads are going, internet is going, in fact, where roads don't go today, right? Number two thing is that we have Aadhaar, which has brought identity online. And of course, the last one, which is UPI, right? It has set money free on the internet and has made the cost of transacting online to be almost near zero. So when you combine the cost of processing a loan, which is trending towards almost zero, and you combine that with a business model, which is primarily around partnerships, the cost of customer acquisition becomes zero. So you don't reinvent the wheel when it comes to acquiring customers, and you take advantage of all of these amazing, technology infrastructures, which this country is basically building continuously, right? And today's government, thankfully, is really, really forward, right? Like UPI is a global phenomenon, right? It's a case study of Aadhaar and UPI. What we've done in India is unbelievable. So all of these things, when you marry together, right, it allows you to create a platform which is a loan distribution platform in a way, right? Now, how is that similar to AWS? So AWS is basically Amazon Web Services, right? And what this is basically anytime you want to spin up an app or a website, in the olden days, you would have to have your own server, right? But today you can start this from any part of the world and have servers in the sky, right? Or in the cloud, as they call it, essentially, right? So that's what Apollo really is. We're an NBFC, which is on cloud, and anybody can integrate into us if they want to start offering loans to their end customers. So that's how we call ourselves the AWS of digital lending.
That is really great to know. You talked about Geo. The digital penetration in India is just at 58%, still lower than the global average of 66%. So even if the digital penetration increases to, let's say, 70%, it opens gate to so many opportunities for you as a company. Okay. So we did interview two NBFCs, right? And their model was they were taking money. They were also non-deposit taking. They were taking money from the institutions like mutual funds and then lending it directly to the consumer. What is your business model? Where are you taking the funds from? What is your value chain basically?
Absolutely. So, from our perspective, funds are coming in from two sources. One is obviously we have our own equity capital, where I'm happy to fund as much money as kind of required in this company to take this forward. And at the same point in time, we work with many other banks and NBFCs as well, and we also have our own shareholders who've been very supportive. They participated in NCDs as well. So primarily, I would say three sources of capital. One is NCDs, second is banks, and third is NBFCs.
NCDs meaning?
This is a form of an instrument where you can raise debt from either an individual or a bank or an NBFC.
Let's take ICICI's example.
Yes. So ICICI could give me a loan in two ways, right? One is they could give me a term loan, or second, they could even participate in an NCD that I remove, right? Which is available for the general public. Anybody could subscribe to it, right? So we did basically have an NCD where we raised a good amount of money, and thankfully in our case that was completely subscribed by our shareholders itself, right? So that's how we get money. In terms of how we deploy the capital, right? So we work on a partnership model, right? Where we work with other fintechs, which could be apps, who are completely digital in nature, and we also work with other NBFCs, right? Which have maybe their own apps and again their own websites.
Can we take an example of Paytm here to?
Sure.
Yeah.
Perfect.
It will be easier for people to understand.
Absolutely, right? Great example. So let's take an example of Paytm. So Paytm is obviously a digital app, and they have many merchants, right? Because a lot of merchants end up using the Paytm QR code to accept payments, right? So a great example over there would be Paytm obviously wants to fund these customers to help them grow their business, because if they grow their business, their revenues will increase and more payments will be processed by Paytm, right? So how do they help them grow their business? They'll give them loans. Now, how does the loan actually happen? The loan happens because they look at the transactions which are getting processed through their systems. This gives them a great insight into how much revenue is this person doing, and they further know at the time of registration what type of business you are. So if you combine the revenue that you're making along with knowing what type of business are you in, they roughly come to know what are your margins as well, right? So as an example, hypothetically, if you are processing say 2 lakh rupees of revenue a month, and they know that this business typically generates maybe 20 to 25% margin, they know roughly on a monthly level you're generating close to 50,000 rupees of profit.
How are they able to know my business just from my transactions?
Because imagine if you have a business, right? If I know your transactions, and hypothetically I know you're in the distribution market, right? In the pharma distribution space, it's pretty common knowledge to know that in that space 12% is more or less the margin. Right?
Got it.
And what ends up happening in this situation is that when you know that this is the margin, on the basis of that they'll give you a loan.
Right?
Got it. And this loan is typically given towards expanding your business. And in our experience, the best loan which is given out is towards a use case which helps you generate more money, right? So in a lot of these cases, if Paytm was smart, I don't know whether they do this, but I would recommend this to them. If they figure out a merchant, right, and that merchant, for example, is, just as a hypothetical example, the fruit seller. Instead of giving them money to buy more fruits, they should acquire the fruits and give them the fruits. Because all this person can do with the fruits is sell it and get more money, right? And expand his business. If you give the person money, money is fungible. You can convert the money into many negative things as well, right?
Mine the gold and make a shovel out of it.
Exactly. So this is a good thing for them to do. Now, what Paytm does with somebody like Apollo is that, one of the challenges when you have this kind of business model for Paytm is that you want to work with a partner who's truly a partner and who's not somebody who's looking to steal your customers, right? Which is a huge challenge in this space. Because typically what happens in the traditional ecosystem is that when Paytm goes to a traditional NBFC or a bank, while the NBFC or the bank works with Paytm on a lead gen model, right? So if you pass on a lead to me, say for 50,000 rupees, I may be giving you 1 to 2% margin, right? So what a lot of these traditional guys do is that they will take the lead for you worth 50,000 rupees. They will say that, no, I can give this person only 20,000. So they'll pay you 1 or 2% on 20,000, and then they'll parallelly call the person from the side and give them the balance 30,000 rupees. And in this way acquire the customer and then continuously continue a relationship with the customer directly by cutting out Paytm. Now that's terrible for Paytm because you've lost your customer, gained very little margin and commission, and third, you've lost the customers in the future as well, and you've potentially given up proprietary data of your transactions to the lender. So it's a very negative relationship. But what Paytm does with somebody like Apollo is that they will establish a one-to-one deep partnership with us, and they have that trust in us for two reasons. Reason number one is Apollo does not do any kind of direct lending at all to end customers. So they are extremely trusting of us, where they are happy to share all the data, where they know that they will be paid the right commission, and at the same point in time they trust that Apollo will not go behind their back and lend to their same customer. Second very important factor is the experience that we are able to give their end customers. With a lot of traditional players, right, there will be a phygital experience, right, where the loan may not go very smoothly. Sometimes it's accepted, then it's later rejected. There is a lot of physical back and forth which ends up happening. Where if you're Paytm and you're giving loans to your best customers, you want to have your best foot forward. So in those cases, they want to go with a player who has the same DNA as them, who has the same technology as them, right? Who can offer a beautiful user experience to their end customers as well. So that's when they love Apollo Finvest as well, right? Because when their team talks to our team and sees our API documentation and sees that, we both are talking the same language, it's very comforting for them.
So from what I understand, ICICI is lending the money to you. You are lending the money to Paytm. Paytm is lending the money to end customer. right?
We lend directly to Paytm's end customer.
Okay.
Yeah.
So if I am a Paytm customer
Yes.
and there's this thing on their app called personal loan, right?
Yes.
If I want that personal loan, Paytm won't be lending me. You will be lending
Yes.
me. Okay.
Yes.
That is your model system. So when you onboard clients like Paytm,
Yeah.
what all metrics do you look at to reduce your non-performing assets?
That's a great question, right?
Mm.
So one of the most important criteria for us is that whenever we onboard a particular lender, right, whether it's a fintech or it is an NBFC, we have to do thorough due diligence on them. And I would break this up into three parts. Number one, we have to do a company level due diligence in terms of understanding their financial strength.
Okay.
One of the most important things for us is because we work with many fintechs and mostly all of them are, I would say startups, right? One of the important criteria for us is either they are profitable or at least they have a 3-year runway, right? Second is, we have to make sure that their existing loan portfolio is healthy.
Okay.
So you have to demonstrate to me, through at least 2 or 3 loan cycles that you know what you're doing, right? Because if you don't know what you're doing, gone are the days in fintech where you're just generating bottom line, or you're generating top line, right? You have to make sure your loan portfolio is healthy, otherwise you're going to be in trouble. And the third, one of the most important factors again, is your operational prowess, right? And what I mean by that is we actually will go to your company, we'll visit you, or our teams will do deep due diligence calls with every level inside your company in terms of who's going to be leading operations, who's going to be looking at risk, who's going to be looking at compliance, all of these factors, right? And because we have so much experience in digital lending and we've been doing it pretty much since the start, we know how to judge people in terms of their knowledge.
Okay.
And this is a highly regulated space. Like this is a space which is very young, and that's why RBI, it's young, but it's very, very fast growth.
Yeah.
So RBI has been pretty much every 2 months coming out with new rules.
They recently debarred 3-4 companies from lending, right?
Exactly, right? So it's a space where you have to really respect the rules, right? And sometimes the easiest way for us to understand a person who's an amateur is a person who says things like, वो rules important नहीं है, या RBI जब भी आएगी देख लेंगे. The minute you say this, right, that shows you're not experienced in this space, and that's the fastest way for us to run away.
Yeah.
Right? RBI has shown many times that it's not somebody to be trifled with. We talk about the fact that they barred DMI and they barred Navi, right? In the past, they've even barred HDFC, they barred American Express. So it's nothing to do with fintechs. I think they've shown that they're very serious in all matters, even when it comes to these large organizations.
Yeah.
So we have this basically, I would say, the last criteria, if I had to summarize all of them, right? Number one is financial health of the company, their portfolio health. Third is their operational prowess. And fourth thing would be industry reputation.
So you are giving loan directly to Paytm's customer, right?
That's
How is this setup beneficial for Paytm?
This is great.
They are just giving you the access to their customers' data, right?
Yes.
So how is it beneficial for them?
I'll tell you. So from Paytm's perspective, right, like I said, the biggest challenge for them right now is monetizing their customer and helping their customers scale up, right? Now, I'll give you an example. When I was in PharmEasy, right, we had raised so much equity capital. And what does an investor want? An investor wants you need to scale up your platform, right? Otherwise, your valuation is not justifiable. So, how do you scale up your platform if your merchants don't have working capital loans?
Yeah.
Right? And this was a real problem that we had. That, we literally had raised 200 million equity. And when we used to go to our merchants and say, okay, like we have to 5x your scale right now, and they used to be like, I have no working capital. I have like 2 lakh rupees with me as working capital every day. I need 20 lakh rupees to achieve what you're saying, and it's everything about him shows that he deserves that 20 lakhs. But when they go to traditional lenders, right, they don't want to underwrite a person who has an online business, right, because they don't know how to.
Yeah.
Right. So this is a very big challenge. So for Paytm, it's a challenge on 2 fronts, right? Challenge number 1 is getting the right funding for its best customers to help them scale up their platform. Like primarily Paytm is a transaction app, right? They have to make sure that the number of transactions happening through Paytm is going to increase. If it doesn't increase, the platform valuation is not justifiable.
Okay.
And second, when they go ahead and they do partnerships, right? Like I said earlier, when they do partnerships with traditional lenders, maybe like an ICICI or HDFC, they'll probably give very small loan through Paytm, give Paytm a very small commission, And instead of giving that person a 50,000 rupee loan, which they should be getting, they'll probably give only 20,000. Paytm will earn commission only 1-2% on 20,000, and the balance 30,000 will be given directly by
And
ICICI.
plus, they are losing the customer.
Yes, because the second time ICICI wants to give a loan, they'll not go through Paytm. They'll directly lend to the customer. And the third biggest problem is the fact that the technology experience and the end experience of the customer is really poor. Because it's not a digital experience, it will be a physical experience.
Okay.
There will be maybe people coming over to your shop and doing all kind of due diligence, etc. Right? Which is not necessarily needed for a loan which is maybe 50,000 or a 1 lakh rupee loan, which is potentially for even 6 months.
Okay.
Right? It's not a long tenure loan.
So this is company's due diligence
Yes.
part, right? So if you are giving loan to me as a Paytm customer, you will be conducting your own due diligence on me as well, right?
Yes.
CIBIL score, credit score, how do you get the access to these type of data?
So all of this comes from the customer, right? So I would say I would break it up into two broad parts. One part is proprietary data that we get about you from somebody like a Paytm, right? Because the way Paytm will come to us is saying that, one, this is my very good customer, because I have a lot of data which says that they are a very good customer. That's one. Number two, to showcase that that person is a very good customer, Paytm will say that, listen, I'm ready to put my skin in the game. So they will also put in FLDG, right? So they will say, I will give you 5% FLDG, which is allowed by RBI.
FLDG?
That's first loss guarantee.
Okay.
Right? So potentially, if I generate, say, a 1 crore portfolio with Paytm, right? As per RBI, you are allowed to give 5% first loss guarantee, which is maybe they'll guarantee for 5 lakh worth of losses, right? In a 1 crore portfolio.
Okay.
So they will do that. Now, why do they do that? Because they will say that, listen, because I'm putting my skin in the game and I'm giving you my best customers, I don't want 1-2% commission. I want maybe 5% commission. Give me 6% commission. Because they are confident that the portfolio will perform really well. So in a way, they are guaranteeing some degree of losses that they will protect me from.
Okay.
Right? So that's what they do. Secondly, from my perspective, I'll underwrite them on two bases. One is the fact that I'll get proprietary data from Paytm, which is transaction data. How long have they been on the platform? Paytm also has location data, right? When was the last transaction conducted from a geolocation perspective? So a lot of additional data points that I get from them, in addition to my underwriting. Now, my underwriting will be basis of obviously bureau. So I will use CIBIL. Second is I will use things like account aggregator, right? Where I will get bank statements from them. I will also look at maybe EPFO data to understand where was this person last time employed. I may be looking at, his shop establishment data. Does he own the shop? Is he rented? How long has he owned the shop? How long has he been there? So I'll use a variety of data points to be able to underwrite this customer holistically in order to give them a loan.
Okay. So whatever you have explained, I'm sure it's just tip of an iceberg. A lot of things go into finally giving the customer a loan. Will I, as a customer, be required to post a collateral?
Absolutely not.
Okay. And what if I default? Who is responsible? Who's gonna bear the loss? Is it gonna be Paytm or you?
So up to 5%, Paytm will bear the loss. Rest of it will be on us.
Okay.
Right?
What is your current NPA ratio?
So today our 90-day GNPA number is 0.8%.
Okay.
Right.
So my next question is, if every big institution, let's say ICICI, HDFC or NBFCs, they are all focusing on reducing their non-performing asset ratio, they all must be focusing on the consumers who have the score in the range of 700 to 800. Where do the people who have score lower than 700 go? Is anyone focusing on them?
That's exactly what the fintech industry is doing, right? So if I had to tell you like a very simple, the way I think about everything is it's a math equation. Okay. So lending is a game, where essentially it's like an algorithm which is running, right? And who has the most data has the ability to determine what is the most profitable path, essentially, right? So I'll give you an example. Say if you were to decide in a lending business that you will give a loan to only people who have a score of more than 800, say hypothetically. This will lead to a situation where potentially you will reject maybe 90% customers, right? Now, why is that not a sensible thing to do? Because yes, you'll have a great quality portfolio, but the cost of customer acquisition will exponentially increase and it will be very difficult for you to scale the business.
Because everyone is running behind the same customers.
Correct. And that base is very small. So even if I forget about the competition, right, the problem statement will be for you that for you to, the cost of customer acquisition to make sense, the cost per customer that you approve will be so high because you'll be rejecting 90% customers, right? And at the same point in time, the number of customers who are 800 plus is so small, it'll be very difficult for you to scale the business. So the math of running the business will not make sense. So that is why, as an example, people decide, okay, let me do maybe 700 plus, but I'll have to do, in the end of the day, there's a lending algorithm which is running at all companies. Maybe some is complex and some is easy. But in the end of the day, what are they trying to optimize?
Okay.
They're optimizing two things. The quality of the portfolio, which is the NPA being the least, and at the same point in time, having the maximum acceptance ratio.
Got it.
Right? That's the two things that you prioritize in an algorithm. Now, what digital lending really does, right? Because the characteristics of a digital loan is essentially what? It is typically short-term in nature, and what I mean by that is all loans will probably be, say, 12 months or maximum 18 months in nature, and they'll usually be smaller ticket sizes, like sub 2 lakh rupees or so, right? So and the third big factor is that you get a lot of data about the customer because I'll be looking at your digital footprint. I'll be taking a lot of information from Paytm. I'll be taking a lot of information that you will be giving me from, say, bureau scores, account aggregator, maybe some app information, some phone information, all of that information, right? All of this essentially when I get, and I'm able to do high frequency lending, right, which is typically shorter tenure, smaller ticket sizes, so the churn of capital is much faster. So when I'm able to do this and I do a large number of loans, essentially I'm able to create a much more robust algorithm, essentially, which allows me to go, maybe instead of having 700 score, right, I'll go to maybe 650 or even a 600. But I'm able to do so in such a way that when I take these two characteristics, that what is my rejection ratio and what is my loss rates, I'm able to balance them in such a way that ultimately I'm able to cover a larger spectrum of customers, and at the same point in time, when I combine it with the APRs I'm charging them, I'm actually making a lot more profit, right? So it's this ratio and this algorithm that you have to balance out, which is possible in digital lending because it's very high frequency.
So do you not think there are a lot of layers involved in the system, because ICICI, then you, then Paytm, then consumer, ultimately consumer is getting exploited, right? So what is the ROI that you're charging, and how are consumers even accepting such high ROI?
So I'll tell you one of the beautiful things about the fintech ecosystem, right? I think the beautiful thing about the fintech ecosystem is, I think it's a blessing for customers, if you ask me. And I'll tell you how. Today, the kind of people are getting access to formal credit because of fintech are the people who before this used to go to informal lending.
Yeah.
Right? And the problems with informal lending are twofold, right? Number one, the APRs over there, right, will be more than 100% annualized.
Yeah.
Right? Number two, God forbid if you don't give them their loan back, the collections that they do are absurd. And none of this is, by the way, in any kind of legal jurisdiction, right? So there's nobody
neither moral nor ethical, nothing.
Absolutely
They'll go
nothing.
Behind your life.
They'll go behind your life, they'll trouble you. And the third biggest problem is that you're not building any credit score. So this is not going to make your next loan any easier, right? So you're not building credibility. But when I look at the formalized lending ecosystem, right, number one, right, the ease of access of getting capital, it's at a click of a button, right? You get capital in seconds. Number two, because of RBI's close supervision on this, the APRs are all monitored deeply by RBI, right? So much so that, recently, like as an example, they even debarred NBFCs as large as Navi, right? Navi has a AUM of more than 10,000 crores. They are a systematically important NBFC, but they didn't think twice before barring them because they smelled that this person may be exploiting customers, right? So that's how strict they are. So APRs are very much in control, right? So APRs, an example, is a function of what we feel may be the loss rates in that portfolio, right? It's a combination of that. And third most important thing is that you will not be exploited when it comes to collections as well. Every single collection phone call, by the way, which happens from a digital lender to a customer is all recorded and can be audited at any point in time by RBI.
Okay, okay.
So if you're doing harsh collections and God forbid there is a complaint which happens, the RBI ombudsman will actually contact you and ask you for a full-fledged report on it with all kind of details. And if you don't do a good job, there will be all kinds of fines, right? So, and the last and the most important thing is that if you are a good actor, right, which pays back loans on times, you're building credibility, you're building your credit score, the pyramid just keeps on getting better, right? Because potentially maybe you start your journey with a little bit of a higher APR loan, right? Maybe 50-60%.
Yeah.
But it goes lower, right? Because next time you'll borrow, probably it will be half, right? And your journey keeps on improving. So this is the beauty of it, essentially, right? And lastly, what I'll say is, see, most of the people who are in the digital lending ecosystem, right? I think most people are looking for short-term loans.
Yeah. What is your loan tenure? Average
Our
loan tenure?
average tenure is about 12 months.
And average ticket size?
About a lakh.
Since the landscape of this consumerism and evolving purchasing power is increasing in India, have you seen this ticket size increasing?
So for us, it was a conscious decision to actually increase the tenure and increase the ticket size. The reason is actually driven by this concept called FOIR.
Okay.
Which is, in simple words, it's seeing how much is the obligations of a customer
to income.
Yes, obligation to income, right? So our general philosophy is that we don't want it to be higher than 50%, right? Which is that if you want a lakh rupees a month, you should not be owing anybody more than 50,000 rupees a month, right? So this is why we basically decided that maybe we'll push ticket sizes to be a little bit higher, but we wanted to push tenures much more so that it becomes easily manageable by the customer, right? So that's the.
So you're creating an entire ecosystem which is easier for you as a company as well as easier for the consumer to pay off the loan as easy as possible.
Yeah.
So since markets are crashing these days and banks are facing a very high liquidity crisis because if you look at a fact, household debt stands at around 120 trillion. During the COVID peak, it was 76 trillion, right? And loans are outpacing deposits. So if banks are not getting the deposits to lend further, how are you getting the funds? Are you facing similar problems?
I think for us, frankly, we are not. I think it's a combination of many things. I think probably the number one thing is, frankly, I think we're too small, right, to have these issues. And secondly, when I look at our debt to equity as a company, right, I think it's sub 1%, 1x basically, right? So I think we have a lot of headroom to go. So maybe there are other companies out there who've really decided to scale up very, very quickly, and maybe their debt to equities is maybe 2.5, 3x, and very early in their journey. So
Bajaj
I think
Finserv's is 3.6x.
Correct, right? So I think Bajaj is a different story, right? I think I always say this with a great degree of respect. See, people who demonstrated their ability to perform are people, in my opinion, who at least have a decade performance, continuously performing for a decade. No, is real. Like as
Going
an example,
through all the cycles and bearing all
absolutely.
of it,
I say this about Apollo as well, right? Like a lot of people ask, you must be happy with the progress Apollo's made over the 7-8 years. And I always say, like, I'll never be happy. I'll probably be the most happy on the 10th year. Because for me, I'll see an average of our performance over the last 10 years, and then I'll feel either we know what we're doing or we have a lot more to learn, right? So I think, people like Bajaj, they can do whatever, right? They know what they're doing. They've demonstrated that.
Okay.
I think I'm talking specifically about the fintech ecosystem, where sometimes people have really scaled up very quickly, having very high debt to equities, and that's where I feel like maybe that's not justified. Given nothing to do with them, I just feel like the ecosystem is too young, right? So for us, I feel we aren't facing those problems today, just because I think for us there's a very large headroom to go.
Okay. So looking at your numbers, I looked at your EBITDA margins as well as the revenues. They are highly fluctuating. Why is that the case?
I think number one is, to be very honest, the only number which I look at as a promoter is ROE. Right? Like that's the number I'm obsessed with. The reason for that is, if you ask me revenue, honestly, in any business, if you ask me, I don't look at revenue. I think revenue is an artifact from the, time where there were factories in India. Right? If you run a factory in India, I think that's the right metric to look at. But from my perspective, at least, the only number I've always bothered with is, what's my PBT or PAT, and how does that, how does that impact my ROE?
Okay.
right? As long as we are having double-digit ROEs, I feel we are doing a good job.
So you are foraying into co-lending, right?
Yeah.
What is it?
So co-lending is basically when you partner with another NBFC, and essentially if you're giving out a loan to say borrower X, you will give it to them ideally in a ratio of 80-20, where 80% comes from Apollo and 20% comes from the opposite NBFC. So it's a great way to do this because
you're leveraging the balance sheet of both the companies basically.
Absolutely. And what that basically means is that the opposite person is putting skin in the game, which we love. And at the same point in time, it ensures, both companies are very, very compliant as well from a lending perspective. Because again, in this game, I think if you're doing a BC model, sometimes the opposite person doesn't care too much because the loan is not on their book. So even if it's a little bit non-compliant, they don't care. But if you do co-lending, I think because there is skin in the game from both parties, people are very, very careful in making sure they're doing only good quality loans and also very compliant.
So, Mikhil, last question. What is your vision for the company given RBI is introducing new and new regulations, especially in this sector, and it's very vigilant, right? So, what is your vision for the company? Let's say 5-6 years down the line.
I think honestly, personally, I love this space, right? I think it's a space which has tremendous potential. I genuinely feel like, I always tell this to people. I think, when I compare it to a place like e-commerce, where e-commerce was in, probably 2009, 2010, I think that's where fintech ecosystem is today. And what's great is that very, very early on, because it's so regulated, I think there's a lot of maturity in the space as well. I think it's a lot of post maturity, if I'm being honest, right? I think because RBI has been like a very strict principle and a parent in a way, saying that we'll not allow you to basically be an irresponsible teen.
Yeah.
So it's a lot of exposure very, very early, which is fantastic. And to me, I think when I think about Apollo, it's going to be always a combination of two things. One is going to be, I think we are going to be growing tremendously. As an example, like over the last 12 months, our AUM has doubled.
Yeah.
Right. So I foresee that kind of going forward as well. But we'll always grow, keeping in mind sensible unit economics and good ROEs. Because if that's not happening, especially as a promoter who has like 70+% stake in the company, I always tell people over here, right? If you don't have double-digit ROEs, then I think we should all shut this down and go on a vacation somewhere. But I think point number 2 is also going to be a big inflection point. Is going to be AI. I think especially from a risk perspective, we've already talked about it in our last earnings call, right? How we've deployed AI all over the company pretty much.
You introduced Senti too, something called Senti.
That's correct, right? So, I mean, we're truly a tech-first company, right? We're running a listed company with just 30 people. And the magic behind all of this is basically using tech wherever possible. Like Senti, as you kind of mentioned, is a fantastic tool, right? It basically monitors any kind of collection calls which are happening real time. And anytime we spot a call which wasn't very efficient or non-compliant, it's immediately flagged, right? So that another person can call up the customer and placate the matter.
Yeah.
And before that, you can imagine how easy is it to manage a call center. You can't, right? Pretty much, because imagine then 10,000 people calling up customers. Who is watching over 10,000 people? There'll probably be a manager who's doing spot checks, one in maybe 100 calls, right? But Senti actually goes through every single call.
Yeah.
So again, all of this is possible because we have so much data, right? We are building something called Supersonic, by the way, which is essentially a very, very proprietary kind of lending algorithm. Again, we've done like 20 lakh loans, right? Since like I kept talking about like high frequency lending, right? This imagine in 8 years we've done 20 lakh loans. So we have so much data around what works and what doesn't, and we are slicing and dicing that data to coming up with a real-time algorithm which determines whether we should do the loan or not. And this algorithm is going to be dynamic because every month, as and when we get repayments, this algorithm will auto-train itself, right, to become better and better. So really, I see the future in two ways. One is growing with great ROEs, and second, using AI to become more and more risk, confident and efficient, pretty much.
I missed out on one question. Let's say I were to default on the loan that I took from you. How will you as a company approach me for the discovery of that loan?
I think
recovery of the loan, sorry. Yeah.
I think what typically happens, right, to be very honest, is the age group that we typically lend into is probably between 25 to 40. That's like majority of our customers, right? And one of the things that we've noticed is, of course, we'll do the typical stuff, right? We have a lot of alternate data on people. So we kind of know, usually where your deliveries happen, right? What is the location of that? right? We will also know, as an example, basis of your geolocation, what are the places that you're usually hanging out in, right? So we'll do very soft things initially. We'll try to call you up, we'll send you SMSs, we'll remind you, we'll try to give you knowledge around why you should not why you should default, why you should not default, right? Which is because it could hurt your bureau,
CIBIL score and everything.
all of those things, right? And we'll try to remind you that everybody should have a good credit history, because at some point in time you need a credit card, you need to need a housing loan, you need a car loan.
So along with creating an ecosystem, you're also making them aware that
absolutely
financial literacy, you're actually spreading the financial literacy by being deep into the system.
Have to, right? To be very honest, a big part of collections is creating awareness. See, if you call up somebody and you tell them that if you don't pay your loan, I'll do a legal case on you, all of these things, I think that's the last resort, to be very honest. Because what we've actually realized, to be very honest, is that at least in our user base, there are very few people who don't want to pay. People who are not paying is because they are in a bad, financial circumstance. Like, I'll give you an example. We've been doing this for 8 years. Sometimes after 3-4 years, a customer will come back and pay back the entire loan with all of his penalties.
Okay.
Because the two reasons, right? Either the reason number one is, all their problems, which were there, they were going through, go away. And they are very young. They are not customers who are like in their 50s or 60s, who, if they are in a bad financial situation, sometimes it's very difficult to recover. There are people in their 20s and early 30s, right? So they have ample of time in their life to recover. And when they do recover, a lot of these people a lot of people will want home loans, a lot of people will want two-wheeler loans, a lot of people will want a car loan, right? And when you go in for that loan, and if you have the bank, first thing they'll say is, listen, you have a loan open for 10,000, 20,000, 50,000 rupees, I cannot give you a loan because it spoiled your bureau history. The first thing they do is call up the lender. Okay, listen, what's happened? Like, I've not paid them. Then we tell them, listen, like, this loan is outstanding. And they say, what is the amount? Please tell us, we'll clear it immediately. Right? So now there's a combination of two things, right? One is, at the time of taking the next loan, they realize they're not getting that. So they'll clear everything in the past.
And they're young.
They're young. So they have time on their hand to recover, right? And the second most important thing, which we are realizing now, there's a lot more financial literacy, by the way, in India post-COVID than pre-COVID.
Yeah.
Because in COVID, right, because of exposure to the financial markets in some way or the other, a lot of people participated in equity, right? So many retail investors went about and made their first, investments.
These days, DIIs are stronger than FIIs, by the way.
Exactly, right? So all of this has led to a really strong financial literacy in the ecosystem. So now people do care. People don't want their bureaus to get spoiled, right? Unless they have no other option. So, to be very honest, the only person who will probably not pay at all now will be like that 0.02% kind of people who are actual fraudsters, right? Who जो किसी और के नाम पे loan ले लेते, right? That situation can happen, right? And that's where we have to use AI and technology at our end, and we've released all of those things, right? We have a face match algorithm, we have liveliness detection, we have all of those algorithms to determine a fraud. So more and more, if I think about the future of lending, I think the biggest goal for a lender will be to cancel out fraud. Because when I think about what the government is also doing with account aggregator, with UPI, your identity, is becoming more and more online, right? So then, it's going to be very difficult to default. Because your identity will be so online, your footprint will be so large online, that if you default, it will be very easy to catch you.
Yeah.
Because imagine if you're ordering everything online. It's very easy to know where you work. It's very easy to know, where you're getting stuff delivered. And Amazon, your KYC may lie, but your Amazon cannot lie. Right? Where your package is coming every single day, people will show up there.
Yeah.
That's the thing.
Okay. Thank you so much, Mikhil. Thank you for joining us
Welcome.
today. It was an insightful conversation.